great future. We're talking real money.
When the market goes down, that's a good thing if you're young. When the market goes down and you're old, well, that can be a bad thing. That's the topic of today's Talking Real Money episode. I'm Don McDonald. That's Tom Cock, and you are you. And we are so grateful you are you. We want you to keep on being you. Don't be anybody but you. What?
More of you.
More of you. We want more of you. We want you to multiply.
Exactly.
Be fruitful and multiply. Be biblical. We want a biblical audience. Well, we don't have that kind of time to wait for you to that kind of multiply. So the only way it's going to work is if you go tell people about the podcast. Okay? Can you do that, please? I mean, we're into the holiday season. 'Tis the time for sharing the good news about the podcast, the Talking Real Money podcast. And send us questions, too. Go to talkingrealmoney.com on the contact form. Tom's running low on paper questions, so this holiday season, send Tom the gift of paper questions.
Yeah, and the trees are not feeling as threatened as they once did, although the smaller trees are feeling very threatened, but the larger firs, not so much.
Yeah, they're feeling better, but you can make them feel worse this holiday season by sending in your questions, because Tom is going to print them. I don't know why, but he's going to. So let's talk about this market thing. We don't like it. We, as investors, do not like it when the stock market declines, when it takes a big beating and drops 20%, 30%, maybe even 50%. It's painful. It hurts. We hate it. But if you're a young person, you should really not. I know young people are going, "Yay, my investment's up. My $12.32 that I just put in my 401k is up." Ooh, no, you want the market to be down. Oh, my $12.32 just bought me a lot more than it did last month. That's a good thing. When you're young, market declines are your friend. You should cheer them on.
More shares at a lower price.
Yeah, you're buying stocks on sale.
Mm-hmm, that's right.
But when you're old, there's this thing that it sounds really confusing, but it's really simple. It's called the sequence of returns risk. I don't know why they had to come up with a name like that, but what does that mean, Tom?
Yeah, what it means is when you're drawing the money and what the market's doing while you're drawing the money out. By the way, you understated a bit on the downturn because I think top to bottom in 2008, 2009, the S&P 500 was actually down 56%. So if you're just in the S&P 500,
rounding.
Okay, if you're just in the S&P 500, that's a number to pay attention to because I'm reading 1929 right now. I'm getting ready to move all the cash. It's a scary book, especially since the author sees a lot of parallels between then and now. So what we're talking about is if you retire, for example, in 2000, 2008,
if
2020,
you retired.
2022, retired. If you said, that's it, and I got to start living off the money. And the market, as you said, goes down. Now you're taking money out and the market is going down. That's sequence of return risk, right? That's the potential for not having your portfolio
sustain you. I know it's a confusing term, but I mean, the concept is really easy. Like if you retired at the beginning of 2008 with about $1 million and you were counting on a $50,000 a year income, you were going to do the flexible withdrawals. You were going to take out $50,000 every year, and that was going to be your spending money in addition to your Social Security. Well, by 2009, your $50,000 is down about $25,000.
Depending on your portfolio.
Depending on if it was all stocks, you're going to be looking at a 50+% decline in your revenue stream for the next year and the year after that and a few years after that as it slowly recovers.
Yeah, and this comes up a lot in planning. This comes up a lot in people writing about retirement because they're talking about, well, if you retired at the wrong time, things could be really ugly for you. So the question then always becomes, well, how do I deal with that? What do I need to do to make sure that I'm not one of those people that does retire in that time, which you can't know. Or what do I need to do with my portfolio, my planning, et cetera, to make sure that's not going to impact me in the way that Don just said? Because no one wants to go from $50,000 a year of income to $25,000 or $30,000, because that's pretty dramatic.
That requires a major lifestyle change. I mean, a major lifestyle change. When
and
you
think
go
how
down
uncomfortable.
by 50%.
Think how uncomfortable you're going to be as well. Whether or not it changes your lifestyle. I mean, it's just to see it go down while you're taking the money out. That's another reason I think for pretty much everybody who's retired to have at least some fixed income.
Well, then, since we cannot know, let's say like I'm getting close to retirement. I might be. I don't know. I'm not right now, but I might be. Let's say I'm getting close to retirement and I'm worried that, the next year, 2, 3, 4 are going to be bad years for stocks. And so what do I do, Tom?
Yeah, well, okay, there's several ideas. There's no perfect one, by the way. There's no one, take this pill, you'll be fine, call me in the morning. But one is, and I think this is a pretty good one, that is creating a cash buffer, if you will, enough money in liquid assets, and that could be in the form of high-yield savings. I guess it could be in the form of short-term CDs, I guess, in some ways, because you could ladder those CDs. It could be just in a savings account, but you have enough to sustain yourself for maybe 1 to 3 years so that no matter what happens in the market, you still have the cash to pay the bills.
So I guess the way that would work is that the closer you are to the ragged edge on your spending, on your budget. So, for example, if you had to have that $50,000 plus Social Security, then you might want to have had 3 years worth of that $50,000 in a liquid account that you can then tap and stop the withdrawals from the account, the growth account that has plummeted, so that you're not further dragging it down.
I think that's very reasonable. I'm not a big fan of cash per se in a portfolio because it has made less than stocks and bonds, but in retirement, I think it could be a good thing. Number 2 would be having this so-called bucket strategy. I don't love the term, but having a bucket of the now, like the cash, the soon, that could be a mix of mostly fixed income and some stocks, and then the later bucket, which would be in the riskier things like stocks, right? Because that's going to give you the growth you're going to need over the long term. I don't think that's an unreasonable strategy for people in retirement either.
Well, and there's another way to approach this, and it's that laddering concept. If you can master the discipline of a ladder, of a CD ladder, which is probably the easiest. You can do it through your brokerage firm with brokered CDs.
Yeah,
is to build a 5-year get me through the bad times ladder, so that you've got $50,000 in that $1 million scenario, $50,000 in CDs coming due every year. If you don't need them, if the portfolio is still sustaining you, then those immediately roll back out to the next 5-year term when they mature in a year. If you do need them, then the next year you take that CD money, you don't extend the ladder. You wait to extend the ladder until your stock portfolio, your more aggressive portfolio, is returning the kind of money you originally needed or were originally getting. And that can sustain you then for 5 years without touching your more aggressive account.
Yeah, and that brings me to the third idea here, which you already mentioned to some extent, and that is, and I think for most people this can work, and that's a flexible withdrawal strategy. In other words, you have your good years, you have your bad years. I really like the idea of trying to build your retirement around mainly the fixed income you're going to get from Social Security and pensions, and then having the savings part be the add-on. That could be good years, as we've talked about, you go to Hawaii. Bad years, you go to the local theme park.
Yeah, but unless it's a 50% decline. I mean, and
right.
that's where we have to add another component to all this. You don't want to be 100% in equities when you're in retirement.
No, unless you've got, $50 million or $20 million.
Unless you don't need anything from it, really.
Correct. Yeah, it's just there for the long haul. I think that's absolutely spot on. We've done many classes, retirements, et cetera, talking about withdrawal strategies. I've really come to love the flexible strategy because I think for most people it will sustain you longer. It will also allow you to feel better We know that people have a lot of angst when they stop working. It's more time to think about these things, and they have a tendency to look at their money more regularly. And when people have angst and they have more time to look at it, they oftentimes make mistakes. They have a tendency to time things. They have a tendency to say, this is never going to get any better. And they move in and out of markets, which is really what you do not want to do.
Maybe that's another good reason not to completely retire, too. Unless you're just bound and determined to you've got a leisure plan. You've got a plan for, I'm just not doing anything, or I'm going traveling, or I'm going hiking, or I'm a golfer and I just have to be on the links all the time. Maybe you want to ease your way in and kind of smooth out some of those bumps, and maybe even have a plan for, should the worst happen, you can kind of sneak back into the workforce temporarily, or have a what do they call them among the fire kids? A side hustle?
Yeah. I guess my side hustle of refereeing probably won't sustain it, but I'm counting on you to come up with something. You're
done
the entrepreneur
with that.
Here.
You're done with that.
No, I actually have a game in 2 weeks I just took.
What about your knee? I'm worried.
I've been taking some pills. And
Are you going to wear a brace or something?
I'm going to wear a brace, too. Yeah, I'm going to drag it behind me. I'll go one-legged. As long as the whistle still works. But
I got the short story podcast. They make more. I think
there you go.
No, they probably, after all I spend on them, they probably don't make more than your reffing. But
all right, well, but I'm not making a whole lot anymore, so it's pretty. And I don't do it for the money. Which always brings me to one that I think most people really struggle with in retirement, especially when it comes to sequence of return risk, and that is maintaining exposure to stocks, to equities, to things that go up and down. People have a tendency, oftentimes, I said, to give up in the aforementioned 2000, 2008, 2020, 2022, et cetera. But they also have a tendency to think, I'm retired now and I shouldn't have anything in stocks because I'm retired. I shouldn't be taking that risk. And yet they need that exposure.
Without a growth component in your portfolio, then your portfolio is going to get eaten alive by inflation. Your spending power is going to decline unless you raise your income. And if you raise your income, your principal amount is going to decline.
That's right.
So you've got to have that growth component, at least a portion. And we've run these numbers every which way. Even a 10% equity exposure does a reasonably good job keeping you from running out of money in retirement.
Gives you some upward motion, upward boost over the long haul, not always in the short term. Here's the other one, and you mentioned this kind of in a nice way, and that is, and I hate telling people this, maybe delay your retirement a little bit, because either A, by reducing and a lot of companies are letting old people like us work less because we're of some value still in some way, and getting some income. That income could replace, in some ways, the full-time income you had and reduce how much you need to take out of that portfolio. Overlooked, I think, in retirement. The problem is
we're going to have if the market does go down, you're going to have a bunch of old people sitting around going, oh, no, this is not fair. How come I got hit with the downturn? Well, that's just the way it works. And also, let me tell you, baby boomers, demographics aren't in your favor.
No, they're not. And for many, many things. So, but those are some few. I mean, here's another couple of things I came up with. You're never going to know the correct, really, rate of withdrawal or the timing of all this. There isn't a right, and that's why all these articles about stuff like this that suggest, well, you can never make it. You don't know. I think Christine Benz will be speaking at Retirement said once the only correct rate of withdrawal we'll know is after we're dead. I mean, then we'll know, well, I didn't take enough or I took too much or what. I mean, that's the only time. So don't beat yourself up about this.
But there are people like us who have run numbers, have run based on historical figures.
Averages.
Well, averages and extremes, too.
That's true. Yeah.
You factor in the historical extremes that have occurred. How bad has it been? Now, could it be worse in the future? Yes. We don't know. We don't know what the future is going to bring. But we've run these numbers, and we've come up with pretty consistently, not just us, but lots of people involved in this industry have come up with this really magical number, which is somewhere between the high threes and maybe a little over 5%.
In terms of the percentage of withdrawal from the portfolio.
Withdrawal. You don't know what the right number is, but we have a high degree of confidence that if you stick within that range, your chances of success are pretty good.
But not if you leave it all in CDs, high yield. You've got to still
No,
have
it won't
exposure
work.
to stocks.
You've got to have some exposure to stock because, well, think about it right now. If your entire portfolio right now was in fixed income, high quality fixed income investments, CDs, money markets, treasuries, your yield would be about 4%.
And how much longer is that going to last?
We don't know, but it would be currently about 4%, which means if you need 5, your portfolio can't do it, and it will very likely not ever be able to do that. Whereas with stocks, you can get to 5. We've run that number. It
many
works.
times.
No, we don't know it works in the future. We know it has worked in the past.
Yeah, and that gets me to number 2 on my list, and that is, and so many of you resist this because you're sure you're going to be okay. Even if you've written the plan, and some of you do on the back of an envelope, some of you do with spreadsheets, is great. I would still have, and I know this sounds like a sales pitch, a professional review. I've done it. Don's done it. I mean, because, somebody else who's looking at going, what about this? What about that? That's not a pitch. That is reality.
Have it done by a good fiduciary anywhere in the country or the world, if you've got one that is going to not try and sell you something.
Yeah, that's exactly right. And that brings me to the final one. And this article this week in the Wall Street Journal reminded me of this because it was a lengthy piece about a guy who used to work at the Wall Street Journal who had worked, obviously, on his retirement, had the savings, had a plan, everything ready to go. And then a couple years in, his wife got Alzheimer's, and his whole retirement is about taking care of her. Life takes unexpected changes, paths. And can you be ready for all those? No. Can you be ready for some or most? Sure. His life is different. He's maintaining the finances, but his whole life is now centered around taking care of his wife. So my take on that is just be prepared for the unexpected, of course. But don't take things too seriously if they don't follow the path that you believe they should, because they necessarily won't. I'll put it that way.
Well, they won't follow it religiously. Exactly.
No.
They'll deviate somewhat. Hey, I did mention earlier that the question flow has declined a bit. Tom does not have as much of that comforting paper in front of him that acts as his podcast security blanket, and so you're depriving him of his joy now. I think I have enough spoken questions, but he's a little low on written. I think it's because he's been spending them a bit too rapidly. He doesn't have a plan. He doesn't have a reading plan because he had so many.
I thought it was all the trees at the house and gave that away or something. So
that was your old house, sir.
Fair enough.
New house doesn't have as many. But did he just die? Wow, you froze up. Okay.
Yep,
so anyway,
I'm back.
All right, I'm going to edit this. Let's see what point am I at?
I think you were asking me a question of some kind, and then you disappeared.
Yeah, the internet froze up there. It's at 18:12, so I'll
Great War
edit. Anyway, so here's what we need you to do. Go to talkingrealmoney.com and send in some questions. Just hit the contact button. You can speak them. You can type them. You type them, you make Tom happy. If you speak them, you make me happy. It's sort of a referendum on who you like best. Do you like Tom best? Speak them. If you like Tom best, type them.
Wow, that's not okay.
He has some. I think he has a couple. Not as many as we'd like, but he's got a couple. Right. Go ahead.
This one comes in from Raleigh, North Carolina. Gary writes us, Tom and Don, thanks for your podcast. I listen to every one, which Gary is a lot of listening because we now have almost 1,800 podcasts. Love Tom's dad jokes. My question, reference to the above-mentioned article by Jason Zweig, which is about should you just buy stocks until you die. I'd like to know how you feel about this article, good and bad points. I'm 74 and past the sequence of returns risk. Yay! Investments in the ultimate buy and hold Merriman portfolio have a high tolerance for risk. In addition, in the IRA have only 18% in stocks, the rest in bonds. Good. If you're going to hold fixed income, the IRA is the right place. In order to rebalance in the future, I have to sell highly appreciated ETFs in my personal account and incur incur large capital gains. Should I just bite the bullet and not let the tax tail wag the dog, or follow Jason Zweig's advice? My broker at Fidelity recommended that I put the pedal to the metal and not worry about the stock-bond ratio, allowing the portfolio to grow as large as possible, since I will be leaving the money to my children. Drawdowns I might incur include a 40 to 50% with an 80-20 portfolio I maintained in this ratio. So, question is, should he just let it ride since he's not going to spend the money and it's being left for somebody else? Or should he, sort of follow his gut and go ahead and make some moves here?
This is one of those that really is dependent on psychology. In your situation, you can leave it in stocks forever. You really can, because who cares? I mean, your kids are going to get a gift no matter. If the stock market declines 50% at the time they inherited it, so what? It's free money. However, what it really boils down to is how your behavior might change in the future. That is the big determinant here. That's why I would suggest before you do anything, you go to talkingrealmoney.com and you take the risk quiz. Find out what your tolerance for risk is, how comfortable you are with it, which will tell you how likely you are to sit tight through another '08 or worse. If you're likely to sit tight through an '08 or worse, then yeah, let it ride.
I think you're spot on. And in terms of Jason Zweig's article, I think we agreed that most people really need exposure to stocks in retirement. I like a balance between stocks and bonds in retirement because you can draw on the bonds when stocks go down, et cetera. But I think that's really good advice, Don. Another question from Renton, Washington. Brian writes, longtime listener from back in the early 90s. Wow. So I'm assuming that would
be the Don McDonald show.
The 1890s for the Don McDonald
show? We really didn't have any radio talk shows in the 1890s yet. Now, there was a little bit of wireless transmission going on, but it was in its infancy.
Not much. First, a comment. Recently on a podcast, you discussed the Washington State Measure 8201 to allow Washington Cares Fund to invest in stocks and equities. I believe both of you thought it was a good idea. My worry is Washington State never been a tax they didn't like or wasted opportunity to tax. If Washington Cares funds are invested in equities and the market goes down, on average of 1 to 4 years, I foresee policymakers claiming the sky is falling because returns have gone backwards, and they will push for increased taxation to make up the shortfall. Look, I only favor owning stocks in any investment plan for the long haul because they've made more than fixed income. That's and I don't know anything about the politics of that. I don't know anything about the shortfall. So
because this really becomes a very political question. That is a highly politicized question.
Yeah, and you've seen this, highly politicized when, for example, I think when Bush Jr. was in, somebody suggested putting Social Security, the trust fund, into stocks, and it was, you can't do that because it'll lose all the money. Well, that hasn't been the case over the long term, and I don't want to make this political, but anyway, so I think people should invest in stocks. But here's the question. Do you have a preference between FSIVX, that's the Fidelity Small Cap Value Index, or FSSNX, the Fidelity Small Cap Index? Appreciating the insights on choosing between these two funds, FSIVX or FSSNX.
We're fans.
I can tell you right off the bat.
We're fans of a value tilt.
Yeah.
So the value would be our first choice, but these are not funds I have looked at much.
No. FSIVX.
FSIVX?
Yes.
Are we sure?
That's what he's got. FS as in Sam.
Yeah, no, it's not coming up.
VX. Fidelity Small Cap Value Index is what he's got.
And then the Small Cap Value Index.
Yep. And then he's got FSSNX.
FISVX.
Okay, so he transposed the S and the I. It wasn't me this time. It was Brian. Okay, Don will be calling you to let you know how you messed up.
I just hadn't looked at the expense ratio, but it's for a small fund. It's really good.
This is Small Value Index.
Yeah. But it's like 5 basis points.
Yeah.
That's really cheap. And what was the symbol on the other one, just out of curiosity?
FSS, 2 S's, N as in Nancy, X as in X-ray.
Fidelity Small Cap Index. He got that one right. And even if he transposed, it wouldn't have been a problem there.
No.
FSS either way.
S and S.
That's 2.5 basis points.
Yeah. I mean, these are inexpensive funds. They're index funds. That's fine. Again, but if I was just picking from the universe, they wouldn't be the ones I would pick because there's nothing wrong with them. And I would pick the value over the small.
There's not a thing wrong with the short value, and it does. Wow, look at it. Doesn't just lean more value; it leans more small too. It's a smaller small and a value-ier value. So that looks good. That looks good.
But this comes back again in picking from the universe of funds for you, the investor. Do you believe that you should just own the index, or should you, shade a little bit more to what the academics are going to tell you that you really want to be more value?
Really? Because
then it's not an index.
It is an index. What they've done is they've just trimmed the index to emphasize smaller and more value. So it has a different rule tilt to it, but it's an index still. It's not as and here's the benefit of it over Avantis or Dimensional: the sharply lower fees.
Yeah, that's substantially less than either a product you're going to get at Dimensional or Avantis.
Yeah, I mean, what is the
AVUV? I think is it 20 or 18 or it's...
Hold on, let me pull it up. No, it's 25, so it's 5 times more expensive.
Yeah, exactly.
Even though we're still talking about pennies, really, on the dollar.
It's cheap, but not as inexpensive. Yeah, I agree.
So the Fidelity Fund looks good to me, the small cap value.
Okay.
All right. Are you
Go
done?
with value. Yeah, I'm done. That's it. The paper cutting is coming to an end, apparently. So.
All right. Let's see.
Yeah.
This is the time of year when you are thinking about giving gifts. And by the way, we mention this every year around this time. If you're going to give a kid
you can send a link.
Give them a Roth.
Link. Oh, I thought you were going to link to my my Christmas gift page.
No. Think about giving money toward a Roth IRA for working kids.
I think that's
Yeah. Instead of giving them some junk, give them a Roth. Give them a future.
Completely. Or 529.
Yeah.
And both in my house, yeah.
Give us the gift of telling more people about the podcast. That would be really nice.
That would be so rewarding. We really appreciate it.
It's the season. You're talking to people. So help them out. Or if you want short stories, go to Lit Reading or New Tales Told or, by the way, a new one that just got boosted up by Apple, my holiday podcast, Seasons Readings. Get it? Seasons Readings? It's kind of a play on words. It's kind of like a pun. Anyway, and if you need some help from an advisor, go to talkingrealmoney.com. Click on the button that says Meet an Advisor. We'll help you for free, for nothing. That'll be our gift to you. No sales pitch, no obligation. Thank you so much for being a part of the show that we call Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.